presentations a bit more interactive. I'm not just here to provide dictation, but to learn from the room as well. And, naturally, we are all here to learn from each other. So one of the most important part of this entire gathering is for us as business persons, as prospective business persons, to come together and do more business. So ultimately, that is the reason for me being here. Now, the title of this presentation, Good to Great, Financing Business Growth in Suriname. Now, this particular idea is a coming together of different ideas. Just a day taking a stroll, prior to taking that stroll, I spoke to one of my business partners. They had a look at our website and they were saying, why haven't you done any of these webinars? We did a series of webinars in the past because there's a number of things that I believe us as entrepreneurs, we are usually very problem solvers, but when it comes to a number of things in the environment, they're sort of overlooked. And I'm an economist, so every decision I take, I look at the efficiency of it. I don't just look at the financing numbers, because profit is good, but profit is also short term. And a business that can be making profit today, tomorrow, it's making no profit. So you also have to look at the economic costs and benefits of that. And that's critical. Now, I like to give my disclaimer whenever I'm doing presentations. Many of the things that are shared in this presentation, they're within context. So they're within context of these presentations because no two companies, no two countries, no two situations are the same. And things can change. And that is one of the key things that should be taken from these presentations. Things are variable. It's if then. It's what if. And so what is important to take away from this presentation, it's not just absolute, because I like to say nothing is absolute. And economists love to say this, all else equal, or ceteris paribus, which is Latin. It simply means that all is almost never equal. It is never equal. When you look at your economic situation, sometimes it will say if investments are low, then interest rates must be high. And if interest rates are low, then investments must be high. But I can tell you about Jamaica. Interest rates are low and investments are low. And interest rates are high and investments is still low. So we look at business cycles because this is one of my favorite topics in economics. When you look at a business cycle, anybody here have ever heard the term business cycle or economic cycle? Anyone? It goes like this. So it's wavy. It's no standard approach. Again, it talks about contingencies, financing. So the good to great framework. So this concept of good to great, because when the idea came to full discussion, I thought about it. I'm a financier. I'm an investor. What would I do? It's not good enough to just be good. And it's Jim Collins himself who says, good is the enemy of great. Because some businesses are good, but good sometimes is not good enough. It's just like saying your best isn't good enough because you can do a little better. So it's important. You may be doing good business now, but you can do a lot better. You can be the best at what you're doing. You could be the best in Suriname, but if you are the best in Suriname, are you still good enough? You could be the best in the Caribbean. How about the world? That is the essence of what this presentation and what the concept of going from good to great is all about. So of course, we look at business cycle, we look at the good to great framework, we look at investor decision making, because ultimately there are many ways to finance your business. There's no single way to finance your business. However, where I'm from, there's a lot of opportunities to get outside investments. And these investors, they particularly look at things from a framework approach. I usually say this to my clients. It's important you start with the end in mind, because ultimately you don't build a single family house or a household the same way you build a tall building. The framework is different. The pillars are different. So if the pillars are built for a house, it's going to be difficult to build a tall building. After you reach maybe the third floor, the fourth floor, the fifth floor will start to cause problems. And so these are critical things that we must keep in mind with all of the various moving parts in doing a business. So we look at financing by stage. We think of startups, we think of mature companies. We look at the case studies as well to look at a few what I'd consider good businesses, you could say even great businesses. And they're of various kinds. Partnership opportunities, of course, my colleague spoke to partnership opportunities. And this is one of the critical things, especially for small businesses. There's just not enough partnership. It's almost a case where we have what we'd call a chip on our shoulder, something to prove. Well, ladies and gentlemen, there's nothing to prove because the largest of largest companies in this world, typically we look at the United States, but there are, of course, many large companies elsewhere, they all partner. If you think of the oil and gas sector here, many of the major multinational companies, what are they doing? They're partnering. So if persons in this room are not prepared to partner, then we're all in trouble. It does not mean necessarily that we have to be doing the same business, but we could. In one hand, I'm an investor, but on another hand, I'm an advisor, I'm a consultant. And that's particularly why I'm here. We're all partnering. So that is one of the major takeaways. Don't too focus on the fancy charts and the deep dive analysis, because that's my area. And I mean, sure, if you have a particular interest in that. But one of the key takeaways is that we all, in our different ways, shape, and form, should be looking at how do we partner to do more. How do we partner to do more? Business. All right. So, of course, partnership opportunities, and at the end, we look at a few takeaways. Now, I won't bore you too much with my economics, but Frontier was a particular name that it came from the production possibilities frontier curve. Now, I would say the name itself came together from different occasions, because the company initially was not this name, but I could not find a better name when I look back in hindsight. So we look at frontier markets. Jamaica is a frontier market. Trinidad and Tobago is a frontier market. Guyana is a frontier market. Suriname is a frontier market. And I particularly like Suriname because I say Suriname is the newest frontier on that curve. So of course, the catalyst, the local imperative, and these are all opportunities for Suriname, for Surinamese business owners to grow and scale their businesses. So if you're already a large business, the opportunity is for you to grow much larger. And if you're small, if you're a startup, the same principle is true. So there's one particular thing I want to say here. Structural barriers. It's one of the major things. It's not a Suriname issue. It's in Jamaica, it's in Barbados, it's in Trinidad and Tobago, etc., etc. And so these are things that collectively, you can't just leave it up to government. Collectively, as business owners, as business leaders, as entrepreneurs, for us to find those solutions and make those recommendations where necessary. Market knowledge and investor participation generally across the Caribbean is very frictional. There's opportunities there, but sometimes they're low take-up for a number of reasons. Sometimes the persons, sometimes the institutions that are offering capital don't really do a good job of sharing the information either. And so I like to put this particular slide in. It's called a business model environment map. And if you look at all of these areas, I could spend all night explaining all of these forces. But ladies and gentlemen, what I want you to take away from this particular diagram is that there's a number of things that are happening in the environment that we you and me and all of us have absolutely no control of. Now, why am I showing you this? It's important to be aware that it exists. It's not so much that you're always going to be an expert at economic infrastructure, switching costs. Some of these things you can't really avoid. But if you're aware of them, then you can start to put contingencies in place. One of the largest opportunities or timing for opportunities, do you guys know when? It's in bad times, a recession, because opportunities present themselves for those who are prepared. This comes from the book Business Model Generation as well. So now on to the matter of good to great. We talk about the flywheel. Now, one would believe that when you're going from good to great, there is particular things that you do differently, correct? You would believe that there are things that you're doing that no one else is doing. However, according to Jim Collins, who's done 5 years of research in putting this book together, what separates good from great is largely, it's a word I'll use, innocuous, but I'll break it down a little further. It's really the little things. It's really the little things that changes the direction. It's the continuous momentum. So if you look at this, it's about momentum. It's about motion, moving in that direction. So if you think of the motion, if this goes against the other direction, and then it goes this way, and then it goes again, what do we expect? That's no motion. You're 2 steps in and another 2 steps out. And so it's important to have that. Disciplined people, he talks about getting the right people on what is called a bus. Sometimes I'll say you meet the right people by sometimes meeting the wrong people. Because a lot of entrepreneurs will tell me, oh, but this idea didn't work out, these business partners didn't work out. But I always say you learn. You learn from the experience and you move. You fail forward. So it's important to have disciplined people, disciplined thought, which I add the strategy, because the strategy is the important focus. Discipline action, the implementation, because there's a lot of implementation gaps in emerging markets, not just here, not just Jamaica, as said before, but the implementation gap needs to be curtailed. And that, after consistent push, the momentum takes over. And that is the concept of the flywheel. It's consistent, it's disciplined, and compounding takes effect. And compounding is a very wonderful word. As a student of finance, compounding talks about how do you move from consistent. So it's consistent returns over a period of time. But once you hit that hurdle, or that, what I would call hinge or jump, everything else changes. And this is where the breakthrough section happens. Now, what usually happens when companies don't go from good to great, it's called the doom loop. So they're doing well. They're doing well. And they go again and they're doing well. And they build in some amount of momentum. And one thing fails and they go back. What usually happens is that they close the strategy, they stop the changes, and they throw in the towel. And ultimately, that now sort of makes it difficult for the business to grow, because you're now starting afresh. And it isn't so much about that starting afresh is always bad. However, it takes a much longer time to get back that momentum of which you had before. So one of the areas now that Jim says that entrepreneurs should focus on, what are you passionate about? What are you the best at? And developing that economic engine. And in the middle is called the hedgehog, because these things, they work in hand in hand, and as he says here, greatness is not a function of circumstance, it's a matter of conscious choice and discipline. And this particular slide, there's another particular flywheel concept. I'm not seeing it here, but it's the same. It talks about leadership, the patience, discipline, and ultimately technology comes at the end, because you can have the best technology, but if the persons are not trained to use the technology efficiently, the technology itself cannot run a business. It takes people to run a business. And in this particular day and age where AI is all around us, it's not that we should not be using AI, but we should not allow the AI to use us, I would say. And these are just a few of this particular slide is not very visible, I must apologize. But a few of the companies, I believe Circuit City is the only one of the 11 that is not doing good to great anymore. They filed for bankruptcy a few years ago. But we have Fannie Mae, Gillette, Kimberly-Clark, Kroger, Nucor, Phillips, Morris, Pitney Bowes, Walgreens, etc., Wells Fargo. And what the concept was about, these were companies that they performed better than the stock market in the United States for 15 consistent years. And so Jim and his team went through wads of data to find out why did these companies perform or outperform the market and outperform other companies so consistently. Now we look more at a company growth cycle. And the company growth cycle has many different phases. So you look at a startup, 0 to 3 years, where the product fit, validation, you're trying to test things. So the first 3 years of a business is really about failure, because most entrepreneurs, just by my own analysis, they fail within 6 months. They fail at the first line at failure. And it's not that failing is a bad thing, because you don't fail unless you give up. You fail forward. Because what you believe may be the best idea. What your friends may believe is the best idea. What people tell you is the best idea. Because you could do an assessment and person say yes, they will buy into your business. And when it touches the market, nobody buys. So I always say to entrepreneurs and business owners, the only way you really know if this idea will work is to test it. So you have to test. So you will understand that this particular cycle is not just for startups, because when you get to the point of growth and maturity and scale, this cycle goes all the way around again. Because it may be a company that's been around for 100 years, but it has to rebrand. Because think of how many companies, think of who remembers Blockbuster? Anybody? Who remembers, I almost said Netflix, but Netflix, of course, became what Blockbuster should have been. Who remembers Kodak? So these are all companies that they were the growth scale, the biggest companies in the world, and they thought that for another 100 years, we will be the biggest and best companies in the world. They failed to innovate, they failed to test the market, and ultimately they went from great to not so great or non-existent at the end of the day. So here, the journey from good to great begins right now. So as Jim likes to say, good is a dangerous place to stop. So it's not good enough just to be good. You have to look at where can you win? Where's your territory? Funding the right ambition. Turning intent into repeatable results. Great vision without great people is irrelevant. And this is one of the areas, having worked in a few large and small companies myself, one of the most critical things I see missing is the lack of training of staff sometimes. If your staff is not properly trained, then the business will take the hit. You need a good team. I usually watch a lot of sports. The best teams have the best players. There's a reason for that. And some company owners will say, what if I train the staff and they leave? But what if you don't train them and they stay? They eat away at your business. And when you train them and they leave, they also give your company a good rapport. Others will want to join your company. And there's a few examples of that I've seen personally in Jamaica. JMB Group is one of those companies that have had a good reputation of actually developing even entrepreneurs within their ranks. And it's a finance company. Imagine a finance company that suggests that you should live your best life and go be a DJ. And they've done it. And it has worked. And a lot of persons over the years say, hey, I want to work at JMB because they support entrepreneurs. So we look at a few disciplines that make capital productive because, of course, I'm also, as I said before, a capital markets thinker. So first, who, then what? Build the team before the strategy. So the team is the strategy. The team is the engine of that strategy. You confronting the brutal facts because there's always the talk about, there's a lot of talk, but very little action. But sometimes the talk fails to actually address the elephant in the room. The hedgehog concept, as you would have seen earlier, is almost the nucleus of those ideas, bringing them together or keeping them together so that flywheel can move. Because if you think of an actual wheel, without the axle keeping it together, that wheel is useless. So culture, discipline, execute without bureaucracy. The technology accelerators are important. So the technology accelerators today, things like AI, machine learning, virtual reality, these are various things. The Internet of Things, we're using Wi-Fi technology. Those are things that it's almost like it's second to nature not to be using them today. And proactive market leadership, because proactivity means that you're not just focused on what people are using today. And a good example, let me see the people with iPhones, right? You would say, I don't know why we needed in the first place a personal computer. But they were the creators of the first personal computer. And then they came with an iPad. Nobody needed that because we had cassette recorders and those things. So they came with things that really we did not need, or we didn't know we needed them. And that's maybe your company today. You can come with products that the market, because the usual traditional approach is to get the market what the market wants. How about giving the market what the market needs? And that is important when you talk about proactivity and innovation. Now, I won't bore you too much in terms of talking about economic cycles because I believe I have made the point already in terms of the various cycles. But what I'll show you, however, is that these cycles, they tend to align at times, and then sometimes they tend to be a mismatch. So in the long run, you will see there's a trend. And once you can observe a trend, you will know what to expect in your business. So it isn't so important to know the exact precise nature of how things will work out in the long run. But if you're around enough, long enough, you will know a recession never lasts. You will know it's important to reinvest in your business, to reinvest in yourselves, because ultimately that will pay good dividends. This is just a depiction of the 2008-2009 financial crisis. So if you look all the way in 2005, there's a sharp drop in terms of the financial cycle. Now, there's a sharp drop. However, there was business growth. The business cycle was good. So the economic numbers were good. And that's why it's so critical for persons on the ground, for local entrepreneurs, for local business owners to observe their markets. Because the numbers at the economic level could be good, but you realize there's no customers coming in. What's happening? The economic numbers tend to be behind. It's a study of what was. It's almost like accounting. It's not so much what is. And so there were people during that time who looked at these numbers. They went down to parts of Miami and realized there were foreclosures aplenty. And that's why they were able to know that something was coming. And it took, based on this chart, an entire 3 years, maybe not 3 years entirely, but another year, maybe another year and a half for everything else to come crashing down. And so the point of this here is just to say the news reports, even the government may be saying it's prosperity, but are you feeling the prosperity? It's good to have the presence of mind of what is happening on the ground and how you prepare and position your business and yourself for these opportunities that exist. And this is just another variation of the previous charts that focuses on how do you fund your business. So when you talk about a startup is very high risk, and a lot of investors tend to shy away from startups. Now, if it wasn't for what is considered startup culture or Silicon Valley culture, you would not have had a Netflix, would not have Uber, Airbnbs, and those many other companies. Amazon, in fact, many of those companies actually did not make a profit within the first 5 years. However, these businesses are usually financed by government grants. They're financed by a group of investors that provide fractional amounts. So if you think of it this way, no single investor has an exposure, maybe more than 5% of the business. And again, why I'm making mention of this, it's about partnership. I usually use the example of an Elon Musk buying Twitter. Facebook, for example, could be even a better example. When they were starting, a group of friends, initially they did what is called bootstrap, meaning that the funds came from family and friends. And so usually that's where startups, because startups will say, even business owners within the first 10 years will say we're not getting financing from a bank. But the thing about it is that banks, where do banks get their capital? Banks get their capital from you. So the banks don't own the money. So they have to be very careful in how they lend that money. So banks really are not in the business of financing businesses the way we think. They're in the businesses of guaranteeing credit to businesses that have a proven business model that are already, they don't need the money essentially. They may have a timing issue in terms of when they're collecting, and the bank will say, okay, you're getting that money next month, we'll give you the money today, and you pay us back next month. So banks are not really, typically, traditional banks, I would say, are not really in the business of funding startups. So if you're funding a startup, you will have to look elsewhere. And maybe even in the first 10 years. And in some cases, even mature companies have an issue finding financing opportunity. Now, if you're a mature company and you're at scale even and having issues finding financing, there are other financing options that are out there in the wider markets where we call the capital markets. The capital markets in a simple form is really the non-traditional banking market. And the capital markets gets its financing from big business people. It gets it from pension funds. It gets it from what is called endowments, trust funds. It gets it from government and sometimes multilateral corporations such as the IADB, the World Bank, etc. So that's where these guys get their funding. So their funding is a little bit different in terms of it's more flexible. Sometimes it goes a little bit more. Red tape isn't the word. It takes a longer time to get because you have to get your business right and structured, but it's more flexible in the long term in terms of you could maybe the first year of taking that financing, you don't have to pay interest or you don't have to make payment on your principal. And that's what I mean when I talk about it's more flexible for businesses to use. Now we look at the 4 clocks. So we talked about economic We talked about a bit of business, the company, and the capital. When you look at a company, how does it finances its operations? Does it finance its operations strictly from income coming in? Now, if a company finances its operations strictly from income coming in, that means that's an opportunity cost. Sometimes that opportunity cost is an opportunity lost because funds typically take time to get in. They may make the sale today, but the sale isn't in cash. There's no monies that has been exchanged. You have to wait another 30 days, maybe up to 90 days. How do you now rectify that? And as I said before, depending on the stage of the business, it may not be able to take bank financing to get the business there. So there's other forms of financing, as mentioned, that can be able to meet those demands for those particular companies. Seeing it through the lens of the investor. Now, I've talked about some of these things already. So it's really not in isolation. It's all connected. The investor will look at the macroeconomic variables of an economy. So, when I talk to investors in Jamaica about Suriname, most of which are yet to really know what's happening. And sometimes that is not so much a fault per se. It's just a matter of where their focus is at. But eventually, when they take notice, they look at also the market size. What's the population size? Because the population makes up the market. Is it growing? How fast is it growing? Management quality of a particular business. Because management is important. Management sets the tone of a company. Management sets the culture. Financial performance. Are these objective metrics? Can these stand up to due diligence, or what is called stress testing, the capital structure of the business? So how do you finance a business? Is the business financed primarily by debt, by borrowing? Is the business financed primarily by revenues? Is the business financed primarily by shareholders or investors injecting capital in the business? And of course, investors also want to look at how do they exit. A thing called private equity that is usually structured in this particular way. They buy into companies, or they buy the entire company, and they want to be able to exit the business in 5 to 7 years. I would say maybe 10 to 15 years in emerging markets. But start with the end in mind, because if investors are looking at the end in mind, it's important that business owners don't just look at their business as their baby, but look at this business as a growing adult. And at what point in time do you provide succession? There's a lot of business owners, especially where I'm from. It's almost, I'm not going to say they wait, but it seems as if they'll wait until they are at the point of retirement or worse. And that's when they're saying, oh, I need to be turning over the business to my kids. And sometimes the kids, they have zero interest in that business. So it's important to start with the end in mind as much as possible. And this is just another particular way to look at it as a funnel. You look at the top level, going all the way down to the specifics of the business. I won't go too much in this because so the trade-offs in business, there's growth, there's risk, there's return. There's times when the level of growth does not support the level of risk taken and ultimately the level of return that you will get. So Suriname, I could use Guyana as one of your closest neighbors. Fastest growing economy in the world. However, some investors at least will ask, yes, it's growing fast. However, is the risk worth the return? It's good to have the return, but what is the amount of risk will we have to take to get our monies in? And I'm not saying this is about Guyana, it's not. I'm just using an example to say the economy can be growing fast, can be growing rapidly, but where's that growth going? Is it infiltrating the entire economy? Or this growth is just domiciled in one place? So you look at also the flexibility of, or the bandwidth, I would like to see, of this particular environment. And the type of refinancing and types of options, because most of the investors that I'm around, they're not trying to replace banks. They're looking to actually partner with the existing financial system. So it's good to ensure that the existing financial system is also supportive of that. Because otherwise it's difficult to do business. You have to get in. Maybe it's so difficult to open a bank account. I don't know. Is it? How easy is it to open a bank account? Those are things that we should be looking at, because besides that, it can be even a turn off for local business owners. So capital and strategic value needs no further explanation. And this is largely some of the markets we look at: private debt, mentioned private equity before, venture capital for startups, and public equity is usually when a business is listed on a stock exchange. So this is the first of 3 case studies. Barita Investments. Now I wanted to particularly look at Barita Investments. Barita Investments been around from 1977, founded by a lady called Rita Humphreys Lewin. It was Jamaica's first securities dealer. And as a female entrepreneur, this was very astounding, to say the least. Now I'd like to say what Rita managed to accomplish was phenomenal. Rita sold the company in 2018. Now Rita sold the company, kept shares in the business with the new owners, alongside the new owners. Those shares went through what we went through earlier, the flywheel effect, and grew exponentially. So at the long and short of it, Rita's value of the business, she made around, I think these numbers are a bit incorrect. It should be 30 million US. She made 30 million US from the amount of shares she sold. And the shares she maintains is valid at another 20 million. Now, if Rita had sold the entire business in 2018, she maybe would have made something like maybe 30 million US or less. But she kept back shares in the business and continued to invest, essentially. And her shares almost doubled. And so that was one of many, I would say, ideas in terms of how you build a business, build a successful business. Don't try to hang on to it until the business becomes devalued, and ultimately uses this business as an asset to create generational wealth for her family. And this is my favorite stock. It's the Trans-Jamaican Highways. And I would say if there's a particular asset class that I love, it's infrastructure. Now, many of these particular infrastructure projects, you think of hospitals, you think of roads, bridges, schools, etc., they usually cost overruns because government and the agencies of government tend to be very inefficient. And I say that without any fear to say it's right across the Caribbean that these things happen. But this particular project is different, because what began as an agreement between the government of Jamaica and 2 French companies eventually became an asset that is owned by major companies in Jamaica, pension funds, insurance companies, etc., as well as ordinary Jamaicans. I have a friend that she now has her deposit for her house after investing in this particular stock. And that's one of the takeaways. It's not so much about I'm saying to invest in the stock market, but invest in your business so that, and one of the takeaways from this as well is to say that layering and partnering also helps to de-risk an investment or a business opportunity. And this is what was done successfully with this particular transaction. And this is just a graph to show initially when the company listed in March 2020. Everyone knew what happened in March 2020. The COVID-19 pandemic hit and the stock went below its listing price, meaning that these persons would have been losing money. It's called a capital I can't remember the word now, but they would have been losing money if they sold. If they held it, they would not lose money. And my friend at the time said to me she was going to sell the stock. And I said, no, don't sell it. You're getting dividends. And dividends is a form of return. And eventually look at where it went. And it's even higher now. So a stock that listed in 2020 for $1.41 is now valued at around $11 and counting. That's a phenomenal climb, but it did not just happen over 1 or 2 years or 3 years. It happened over several years. And really that is the purpose of building your business. It doesn't happen overnight. And of course, my third case study, and we're particularly proud of this partnership. I mean, of course, Nirvan would have went through what Insight does. We did a transaction for them that took place over 9 months, significant amount of negotiations back and forth. But those kind of partnerships, they're not built in a night, or they're not just built in one day. And we have been successful at it. And we continue to work together. And we'll be looking to work together with a lot of persons here in this room, as well as other persons. And this was just a bit of why we made it work. Yeah, and I think I'm at questions.
Thank you. So this is your opportunity to ask questions.
The event was very impactful and very informative. Yeah, I've learned a lot about starting my own business. It really triggered me to actually think about starting my own business. The most surprising thing for me was definitely how entrepreneurs can go from 0 to 100 and just like that lose everything. But just they keep motivating their self to not to give up, but just to dust yourself off and try again with your business. Good to great, I will answer that. About the good to great is if you're good, that's okay. But if you want to create impact, you need to be great. So for me, being good is good, but if you want to go further, be great. Thank you.
Ja, zes was informatief. Heel veel geleerd, ook wat betreft de theorieën. Merken we dus dat we het echt gewoon kunnen toepassen in ons dagelijks leven, je dagelijkse onderneming. En de most surprising thing natuurlijk was ook wel om ja, te leren en om te zien de raakvlakken die we hebben tussen Suriname en de overige Caribische landen. En wat we eigenlijk ook wel kunnen meenemen van de lessons learned die zij dus hebben meegehad.
I think it's very fruitful to see business from another angle. And I'm looking forward to have the notes, the presentation, because now it was very fast. And then we can study the points which are of our own interest, you know. And another thing is that we can share it with others. I'm a senior business person, but I have a family business, so I can share it with my children, and they can see the other interesting things in it than I see, because I'm looking, for instance, I'm looking at the opportunities, but they are looking at the finances or the investments and so on and so on. So I think that we have a lot of stuff to discuss in the coming time. It was very, very good. I love it. And I hope they will have more of these opportunities.
Was there anything surprising you today?
Surprising?
Or any new concept?
I'm one of the businesses. Our businesses is wooden houses, prefabricated Surinamese wooden houses. And we're standing here in a wooden house, monumental wooden house. I love it. I love it. I love it. And I think that we are so rich. Surinamese people are so rich as a people, as a country, we are rich. And we should do this more, bring business to the people.